analysis master who specializes in FX, and he is going to talk to you tonight about technical analysis for FX options. Before I introduce Sunil and get into his presentation, I do want to take one moment to take a look at our positions that we've got on currently, so that we can, I know we talked about this last night. My plan to do is I will show us where we currently are on those gamma trading straddles that we have, and I am then going to probably put out some more orders. And what I'll do is, while Sunil is speaking, I may just send up chats showing what orders I've put out to hedge the positions that we are working. So let's take just a quick look. I hope everyone got their email today from OU to give you the spreadsheet that I told you we had worked on. Just have to make sure I'm recording this meeting, which I am. Bring up that spreadsheet. I'm going to switch to my sharing. Quick review. We had put on 100 straddles. We had put on 100 straddles. We had talked about that. I put them on this morning, and I had sent out everybody. It was an interim, kind of an update as to where we were on our positions. These were the closing quotes from a while ago. These were the most recent quotes that we had. Based on that and the deltas that we had, here were our net positions. The only one that we're really long is right here. We happen to be long 1,000 or so, 1,100 Aussie dollar. We're currently working two orders that are slightly above the market, and I'm going to leave them there. Everything else has come up pretty flat to this point, and just you know, these little color codings were telling me that we had positions, we had trades out, and we're working. They've executed, so I want to get them off the screen so that they don't confuse us. But what we've got so far is the spreadsheet seems to be kind of high tech. There, as far as I'm concerned, is really only one way to track the trades that you have out, particularly when you're flipping gamma, and it's old school legal paper. You don't have to be legal paper, just a pad of paper and a pen. I line up all my buys on my left side of my paper, the sells on the right side of the paper, and they sit there all day. And as they get filled, I put a little, you can put a check mark of an X. I happen to use a half a parentheses to tell me that that's a filled order. So I can tell quickly what orders am I working, where am I working them, and what have I bought and sold, and what's my net position on the day, and then therefore what position do I need to enter into our spreadsheet here. So everything here is pretty tight on our deltas. We were able to get, we're carrying a little bit of a long delta in the Aussie dollar. It's gotten battered pretty good today. I'm leaning a little bit long because we're sitting with almost 2,680 gamma. So at the level where we are just about now, we could sell the 1,000. I'm leaning a little bit long, one of those personal preference things, and I'm going to, what I'll do, I'm going to flip over and show you some of the trades that we've done. I've taken off all of the orders that I had outstanding. I've canceled everything. I'm going to put out new limit orders for the evening, and I will flip those into the chat window while Sunil is speaking, just with prices. I'm going to try not to interrupt what he's doing, but just to let everybody see the orders that have gone out that we will be working. We currently have no open orders working right now in Thinkorswim. I wanted to cancel them until we were able to get up and get running this evening so that I could put them in live. I'm going to switch over right now to here is Thinkorswim, and this is current look at the dashboard and our current position. We are short 5 euro. We are short 5 pound. We are long $4 Swiss. We are long $4 Canadian, and we are long $4 yen as our head. And I usually suggest a lot of Guinness, Kim, is what I suggest. Now, what I try to do is the idea behind this gamma trading, and this is one of those things that you're not going to find in a book, and it really, for me, is very helpful. Although this spreadsheet helps me calculate where I need to put my orders out, I really like having a notepad with me with all my orders. And what I'll do is when I sell something, then I immediately look, okay, where in my position do I want to put a buy out, and just play that back and forth. You can set it up in the beginning of the day. When you get more advanced, you could even set up contingent orders that once I sell my spot here, I would like to put a buy in at this level below. It's a contingency order within Thinkorswim. But you don't necessarily have to be watching this gamma every single minute of the day. But what you do need to do, if you're not going to be watching it every minute, is you need to prepare. Well, it's hard to say. I mean, the bottom line, Kim, is can I flip enough to cover my decay? I have a couple flips today where, and I was, as I had said, I was playing it tighter during the day, except for that Aussie position, where I was trying to flip about 40 or 50 pips with a 5 lot. So that's about $200. Because if you look at, let me quickly go to the monitor, switch this to capitalization, and take all these down because they don't really matter right now. If you look at it, the decay is creeping up, and the reason that it is creeping up on this one is because we're now trading a September straddle versus the October straddle. So we have a little bit more decay, but we have a little bit more gamma. We're looking at nearly 15,780 gamma. It's costing us about $3,000 a day. The options today, net on the day, we're up about 2,800 on the open P&L for the day, and our Forex says we've lost about $100 net on net. That's not realized profit, so it's not quite an accurate number. It looks like we're a little bit up for the day. So on net, it looks like we probably had a decent day flipping the gamma. We'll probably have a better look, but you want to break it down into, again, I wouldn't suggest going and doing 6 positions. Do 1, and that your question comes down to, if it's 1 flip and you cover the gamma, then that's a good day. If it's 12 flips and you don't cover the gamma, then that's not a good day. And if you find yourself not covering the gamma, then you need to reconsider the position. So, again, I'm going to put this out. This just gives you a look at our current deltas. I'm going to update this on the spreadsheet behind the scenes while Sunil is giving his presentation, and I'm also going to put out I'll just send you out, again, through the chat window. I can set the OCOs. Normally, I'll have a buy and a sell above and below the market, so they really are not OCOs. I want to have both of them out as limit orders, because if it goes down, I want to buy, and that does not impact, if it goes up, me wanting to sell that. So I don't use OCOs for these because I really want both to trade. This is not a thing where I'm trying to take my position off. I'm just trying to flip my position back and forth. So, again, I'll do this behind the scenes right now. We do have some orders in. If I happen to get any fills, I will bring them across. And at the end of the evening, after Sunil is done and you've got chart on the brain and you're ready to look at something a little bit less complicated, because I know those charts, Sunil will make them nice and easy for you, but they're very, very interesting. We'll talk about at the end of the night, whatever that would be, we'll talk about the position and specifically about the spreadsheet, how to use it, and we'll be able to get ready for tomorrow night's class. So without further ado, I'd like to introduce Sunil. I'm going to let Sunil pronounce his last name for you because I unfortunately would not do him justice, and that wouldn't be fair. Sunil joined Options University this month. He's going to be working with me in our FX trading group. He's been trading in the Forex market for the past 6 years, and he's been devising simple trading strategies, which is part of the reason why we've looked towards having him come aboard, that he devises drawing upon his in-depth knowledge of technical analysis. He has worked as a content provider and article writer for different websites. He'll now be providing content and articles for OU, Sunil's first name is Sunil. He will give you his last name. I do not want to butcher his last name, and I'm sure he's laughing right now. Sunil has also contributed technical analysis articles to magazines such as Traders Magazine, the Trading Journal, and Your Trading Edge. He's an FX expert on the panel for the IB Times. He also conducts live trading sessions and webinars, and he likes to develop individual plans for traders who are looking to capitalize on technical analysis in the spot market. So I'm going to switch away from my email, and we are going to go to the documents that he's provided for us. Sunil, if you are there, please pick up the ball, and we all look forward to your presentation this evening.
Everybody.
Well, this is the part where I get.
Sound check.
I was going to say, that's the part where I get nervous when I didn't hear your voice. Thank you.
I'm fine. Right. Thank you so much, Greg. Thank you very much. Hello, everybody from here, from Sunil. It's a great pleasure being over here with Options University and with everybody over here to discuss technical analysis, specifically charts. As Greg would say, let me introduce myself. Name is Sunil. My last name is Mangwani. So it is Mangwani. You really don't have to get into that. Sunil is just fine. Sunil is nice and uncomplicated. Well, without delaying things too much, the main purpose of technical analysis, or me being over here to discuss any kind of, we are looking at charts, right? Now there are two schools of thoughts. Thank you, Elizabeth. Thank you so much. Spot Forex or options Forex. What happens is people look at it from the fundamental point of view. People look at it from the technical point of view. The fundamentalists have their own way of looking at it, and they always consider the technical analysts to talk just mumbo jumbo, as they say. I mean, nothing really matters. But I'm a hardcore technical analyst, and I would believe in charts. Finally, I want to give you a background about what exactly is technical analysis, why it should work, why it has worked for me, and if nothing else, why one should really look at it. You really don't have to get into too much details, get into complicated, until and unless you really want to. Then, of course, we are the right persons. You are here to teach you all those things. But the point is, technical and fundamental analysis can coexist with each other. You can always use both of them to give you a better edge over the markets. Finally, when you're trading any financial instrument, this is a business of probabilities, as they say, and you are looking for an edge. Once you have that edge, you should be able to capitalize on that edge to give you profits. Finally, you are trading to make money. You are not trading to predict the market. As I always tell my traders, you are not an astrologer. You are a trader. You are not concerned about when and where price is going to go. You are going to follow price. This is where technical analysis comes in handy. Right? Let's go over the slides. Herbert, as we will go into today, is just the basics of technical analysis. Once we start off with our spot forex courses here on Options University, we will be going over it, and I could probably give you a lot of examples about even when the fundamentals are not what they seem. It is the technical analysis finally which counts. Well, as I said, I'm a hardcore technical analyst. I believe the fundamentals, or the short-term fundamentals, not the long-term ones. You have your moves, or you have the data affecting your spot forex market, or even your options, your currency options for that matter. News releases. You may have seen today now, the first Friday of every month, the non-farm payrolls data has become something very big, where the euro and the pound is expected to make about 200-point moves in a matter of a minute or so. A lot of people trying to capitalize on that. But you may have noticed, if at all you are trading that, or if you are looking at that, even when the data is favorable to the US dollar, it might not rally. It would just drop somewhere. How do you explain that? Well, my take on that is it is part of a technical analysis. It is part of a pattern which is being fulfilled. And your fundamentals just become an excuse to fulfill certain technical patterns which you may not be aware of, which may be playing out somewhere. Right? Let's not get into that. We will go into that subsequently. Let's start off with the basics of technical analysis, what exactly it is, and how does one look at a chart? What are the basic factors that one needs to look at a chart? Analysis known as charting. So it is an attempt to predict future prices by studying the trading history. So you're looking at past prices to try and predict future prices. The technical analyst, so I would call myself a technical analyst, they evaluate the securities or any currency, commodity, equities, anything. They analyze the data generated by market activity based on past prices volumes, use charts and other tools to identify patterns that can suggest future activity. Now underline that can suggest future activity. There are a lot of misconceptions about technical analysis, which, as they say, the fundamentalists say it's mumbo jumbo. The whole point is nothing ever really works 100% of the time, which you and me are well aware of. The patterns will suggest future activity. You have to take it with a pinch of salt, and you have to use your own discretion to decide whether it's going to be correct or it's not going to be correct. It's never an exact science. Chart reading, as they say, is more of an art than a science. Now, this need not dissuade anybody, because finally, price, I believe, moves in a definite pattern. Price action is never random. And if you can decipher the patterns within a chart, well, you can at least estimate quite fairly where price is expected to go. Right, coming down to technical analysis. Now, the bottom line, this is the most important part, or the concept of technical analysis, the foundation of technical analysis. It assumes that at any given time, the currency's price, I'm talking about currency specifically today, reflects everything that has or could affect the markets. Just what I was telling you, including your fundamental factors, broader economic factors, and the market psychology are all priced in, removing the need to actually consider these factors separately. We are not going to consider these factors at all. When I am looking at a chart, the fundamental factors, the economic factors, everything takes a backseat for me, because I believe that everything has been priced into the price movements as of now. So this leaves only the analysis of the price movement, which is a product of supply and demand. One very brief point, let me just go a little off track over here. Whenever you are trading a currency, you're trading an equity, a share, you're trading a commodity, are you actually trading that? You may be physically or maybe on paper buying and selling a currency, a commodity. But what you are actually trading is you are trading other traders. Finally, if you are buying, someone is selling. And if somebody is buying, you are selling. It becomes a zero-sum game. So you are trading other traders, which is nothing but the net effect of supply and demand. Now, whether you look at it from a technical analysis point of view, whether you look at it from a fundamental analysis point of view, the bottom line is it is a result of supply and demand. Can we not put it down in a mathematical? There seems to be confirm sound is fine. Somebody said no sound. Am I okay?
I'm
so
fine
far?
With the sound. I'm fine with the sound, Sunil. Dave, would you may want to try logging out and logging back in, Dave, if you're having a problem, because I've got Sunil loud and clear. Thanks for checking. I'm right here.
All right. Finally, everything is a result of supply and demand. And if you put down this supply and demand in a mathematical term, in a logical term, this is what technical analysis is all about. It identifies, it tries, excuse me, to factor in your supply and demand into a certain pattern. This is what technical analysis is, and this is how it should be looked at it. It should never be looked at it as a leading option or as a leading indicator that if I study technical analysis, I can identify where this currency is going to go. No, that's not it. Again, another brief point which I think is very important, a little off track over here. A lot of traders get into the forex markets. I specialize in the spot. Now, Greg would be more aware of the options, and I'm sure he's come across similar situations. Traders come into the market with absolutely unrealistic expectations, which is not surprising. There are a lot of brokers advertising it. Start your account with $500, trade in your pajamas, 24-hour market, make $10,000 a month. This is a serious business. And like any other business, you have to work on it. And finally, what they do is they take a course on some technical analysis. They look at, okay, I know the stochastics quite well today. And if the stochastics is overbought, that means the currency is going to drop. And they do that. Well, that's not it. Technical analysis is not a science. If it was, very frankly, everybody would have been making money. And you and me wouldn't have been sitting over here. It's more of an art, and one should look at technical analysis as an indication towards where price is expected to go, not as a confirmation that this is what it is. All right, so I'm going to buy and I'm going to sell and it's going to work. It doesn't work. It's my job to give you the facts about technical analysis. You must take it in the correct sense. It works. It does not undermine the effect of technical analysis. In any case, it definitely works. I could give you lots of examples where certain price patterns or certain Fibonacci numbers, pivots, they really work so well, it sometimes becomes amazing. But again, it should never be taken as a leading indicator. Right? Getting back to technical analysis, there are different methods and tools used in technical analysis. Now, all of them rely on the assumption that price patterns and trends exist and they can be identified and exploited, which is what technical analysis is all about. You assume that price patterns and trends exist in the market. Right? Now, this again is one of the very important points, the 3 points of technical analysis. This is the base of technical analysis, the underlying assumptions. The market discounts everything. Now, when somebody asked, even when fundamental analysis is not as clear, well, the market discounts everything. You have heard the sayings, buy the fact and sell the rumors, or sorry, buy the rumors and sell the fact. Well, it is something of that sort. Over a period of time, price reflects all information impacting the currency and its future potential direction. Second point, price tends to trend or form patterns. Now, most technical strategies are based on this assumption, which simply means that after a trend has been established, the future price movement is more likely to be in the same direction as the existing trend than to be against it. Now, Forex, specifically the spot Forex market, the Forex currencies, they are a trending market. It is considered to be one of the most trending markets compared to all the other markets. So this gives rise to technical analysis. Technical analysis works very well with liquid markets, Forex being one of them. Finally, what you and me are looking for is price movement. If price is absolutely flat, it's moving in a band, neither do your options work, nor does my technical analysis work. We are looking for movements. And that is the reason the Forex markets has got such a lot of liquidity in it that this becomes an excellent place to apply your option strategies, your technical analysis. It works. Excuse me. Right, last point, history tends to repeat itself. Price trends occur and reoccur in patterns that are fairly predictable, which is a fact. As we will go over subsequently detailed into technical analysis in the future classes, you will see the patterns which are fairly predictable. And the repetitive nature of price movements is attributed to market psychology. Now, some other time, in another class, when we do have the time, everybody's heard of what an Elliott wave is. There is an excellent take on Elliott wave which very frankly one of my mentors had showed it to me, and I really liked it so much that I could sit across to you, take a chart and explain to you how an Elliott wave can be formed or is formed based on psychology. When a new trader is entering the market, this is what he thinks, this is what he assumes, which is most of the traders think like that. So price tends to move in waves. It tends to form certain patterns which are based on market psychology. The market price is driven by you and me. It's driven by the traders. They are the people who drive the market. So prices have to move in a certain pattern. And if you can understand the psychology behind why prices are moving, believe me, you will be in the top 50% bracket of people who do not even know why prices are moving. Your technical analysis, you must know why. It's not necessarily enough knowing where and when, you must know why. All right, let's get into the technical analysis. Now, the first point about technical analysis is your candlestick charts. There are 4 different kinds of charts. You have the line chart, you have the bar chart, and you have the candlestick charts. There are 2 different kinds of bar charts over here. You also have point and figure detail, but we consider the candlestick to be one of the most effective charting systems available today. They provide a variety of information on the current market prices. They are relatively very easy to read. They can be used by short-term, long-term traders alike, and they are used by different systems. Now, coming back to the earlier point, your candlestick shows this fact very well what I was talking about. There are only 2 groups of people in the market. There are buyers and there are sellers. It's as simple as that. If you're not a buyer and a seller, you're not in the market. Right? You're on the sideline somewhere. Anybody who's in the market obviously either wants to buy or sell based on anticipated price movements. Now, candlesticks figure out which group is in control of the price action. This by itself is a very, very important information, which your line chart or your bar chart may not give you so effectively. Image on how a candlestick is constructed. Right? Very briefly, can you just give me one moment? I'll just put on one. I can just show this to you. This is a very interesting factor. If you look at this, this is a up and lows of this bar are called as wicks. So you have the actual bar and you have a wick on top and you have a wick beneath. That wick, your entire range from your high to real body, as they say, is the open and the close. So at one glance, you can make out where price has opened, where price has closed in that particular time frame. How high has it gone? What is the low it has made? Right? So when currencies close at the top part of the bar, you can conclude that the buyers are in control, which your candlestick. Right? You're looking at this, the filled bar, the maroon bar on the right hand side is a down close bar. So you can say it's a bearish bar where the sellers are in control. The white bar, every chart has got a different way of coloring it. The white bar is an up close bar. You can say that buyers are in control. Now at a single glance, you can make out for that particular time frame where you are, who is in charge of the market, and you should try and remain with the trend. It's not a very complicated thing, and you really need not get into the details of it. Just try and understand how candlesticks and why do they work. Let's get down to trends. We were talking about remaining in the direction of the trend. Now, what exactly is a trend? When you talk about it, it's again, somebody had mentioned it in one of my previous sessions, a very nice definition that if a 5-year-old can identify a trend, that is what a trend is. As simple as that. If you have prices moving constantly towards the upside and you can plot a line saying that this is a trend, then it is an uptrend. If it is not, then there is no trend. People tend to complicate things a little too much, trying to look at lots of trends. Look at it very simple. Right? Price never moves in a straight line. As I explained, it is the psychology of the market, and price always moves in waves, and it moves in series of highs and lows. Now, these highs and lows constitute a trend. Main trends can be divided into three separate stages. First and foremost, we'll go over a chart example in the next slide, is your primary or your major trend. This trend becomes now, you can classify your kind of traders based on these trends. Your primary trend is for investors who want to buy and hold currencies for a longer time. Now these are the investors who would look more at fundamental factors also, because on a longer time basis, fundamental factors do affect the movement of currencies. Technicals for me, of course, I would say come first, but fundamentals has to be taken care of when you're a investor, when you're looking at a larger term time frame. Secondary trends are counter trend movements in the direction of the major trend. Now these counter trend movements cause price to correct back to a more realistic price value. One more thing about price which I could tell you, which is a very, very simple concept, which if you can keep in mind, you can take advantage of this. Whenever price stretches beyond its means, it moves beyond the normal average, it would tend to pull back. It's like a rubber band effect. So price always moves in waves. The minute it goes further off, it will give you a pullback somewhere to a certain extent, which of course we can determine by technical analysis to what extent it could come down to. But bottom line is, if you are aware of these simple facts, it makes you a better trader, because you are not getting emotionally involved with the market. That I have seen a lot of traders getting into a trend when the trend is halfway through and they think they are going to miss out on the trend. The minute you get into a trade, price suddenly seems to reverse on you. And a lot of traders tell me the market is against me. And I'm sure there's this guy out there, or there's these people out there who know exactly when I'm going to enter the market, and whenever I enter the market, price suddenly reverses on me. Well, if you are aware of facts like this, that there will always be pullbacks and price will come back to an average, you would wait for a better position to get into a trade. Right? So these are the secondary trends. Then comes your intermediate trends, where you would probably look at intraday movements, where price swings in both ways. Now the intermediate trend is important to the investors to spot the best price level. They would try and identify the correct entry levels to re-enter or add on to the trades. Then comes the absolute minor trends, absolute day-to-day price fluctuations. These are important to day traders who want to either enter or exit a trade. Now if you want to have a look at this, we have a chart example, right? Your major primary trend is your main trend. Now I'm looking at one example of a weekly time frame of the Australian dollar. This is one chart which I have used for everything, for all the technical tools that we will be using. It seems to give quite a lot of information on it. Primary trend, absolutely up direction, absolutely in an uptrend. Now simply as I say, it's a trend if a 5-year-old could tell you it's a trend. Looking at a chart simply like this, anybody could tell you this price is in an uptrend. You have a secondary trend which goes against it. Then you have an intermediate trend where prices will move both ways, in the direction of the primary trend and against it. Minor trends are not visible on this chart, but if you lower down, if you go down to smaller time frames, probably this you could be able to spot some minor trends inside it. Right? So these are the main trends. Now, types of trends. Obviously, we are looking at, yes, Rene, birds. I'm in the middle of nature over here. Well, that gives me a chance. Okay, everything fine so far. Voice okay? You can understand. There are no questions. We'll be taking questions at the end of the lessons, but just a small confirmation. Yes, Rene, thank you. It does sound good over here. It's early morning for me over here, and with the birds chirping, it's a nice chirpy day. All right, let's get back to it. Types of trends. Now, it's important to understand and identify trends. These PDFs would be given to you, so you can keep it in case. And if you have any questions about this, we could get back at the end of the session. Please feel. So let's go over to the types of trend. Now, we were looking at the main trends. What exactly, how would you identify it? I'm sorry, George, about the last 3-4 days, are you talking about the movements on the down? No, not really, George. This is something, if I have time at the end of the session, I could show you one more chart, which, as I said, I described in my background. I do conduct live trading sessions, and I have a certain set of subscribers where we identify trading opportunities in real time. We have been waiting for the Australian dollar to go down, and I'm expecting a little more price movement. I could just show you one particular chart pattern once we finish with the session. All right, George, if I have time, would you remind me about it? I'll show you an interesting chart pattern which is more of proving my point that technical analysis works more than anything else. Right? It's never a question of, okay, this was a good trade or it's a bad trade. It is your basics which matter. It's the fundamentals, that this is what should work in the market. This is what we try to follow. All right, types of trends. Now, there is a very important saying. No, George, that was a weekly chart. That was a weekly chart of the Australian dollar. The AUD-USD spot pair, weekly chart. And I was talking about some price patterns on the weekly chart. Right. Two very important sayings in technical analysis. The trend is your friend, and don't buck the trend. Which is, very frankly, it is the base of your technical analysis, and one must remember that. So, which becomes important to know on what kind of trend you are in. Right? Trend analysis is your first and foremost foundation of technical analysis. That you must understand what the trend is, where it is, and when it is expected to change. Now, the tools which we will be looking at try to identify exactly the same thing, because that is finally your base. So there are three types of trends, very basic stuff. Uptrend, when each successive peak and trough, peak or valley, highs and lows of price movement is higher, it's an upward trend. Downward trend, obviously, if your highs and lows are getting lower. And there is also a sideways trend, you can call it a trend. Because if I'm looking at something on a weekly time frame, and if it's in a sideways trend, probably on a 1-hour chart, on a 60-minute chart, you would try and get some intraday ups or down trends in it. So a horizontal trend should also be taken cognizance of. Where there is little movement up or down, it's a sideways or horizontal movement. This sideways trend actually not a trend, but a lack of well-defined trend in either direction. Again, it depends on what time frame you're looking at. Herbert, the Elliott wave consists of a 5-wave, right? It is 3 impulsive waves and 2 corrective waves constituting one part of an Elliott wave, which of course is we could go over subsequently when. And as far as possible, it is very briefly to answer your question, a 5-wave is followed by a 3-wave. You have a 5 impulsive wave and you're looking at the 3-wave corrective after that. So let's just get the basics correct, and we will go over, if we do have time, I will be over here, I will be coming in quite often for technical analysis, and we will definitely go over this. Lots of Elliott waves really do work, and this is one thing which I would want to go over subsequently. Right, so we were looking at technical analysis, types of trends, not trend lines, simplest things. One thing which I always advocate, which I always tell my subscribers, I would tell everybody, try to keep things simple. Keep it absolutely simple, don't complicate things. Trend lines, I have found, are the most effective way of determining a trend and determining a change of trend. This is nothing but a charting technique that adds a line to the chart to represent the trends. These lines are used to clearly show the trend and also used for identifying trend reversals. An upward line, obviously, you would plot on the lows which are rising. So this upward line represents a support that price forms every time it moves. Price forms support on this. This kind of trend line helps trader anticipate the point where price will begin moving again, so you are looking at a possible support area. Break of this line is the simplest indication of a change of trend. Similarly with a downtrend, right? Let's have a look at this same chart. Now, if we are talking about an uptrend, if I connect my lows which are rallying, this becomes an uptrend. Till the time price is over here, it's in an uptrend. I could just keep plotting my trend lines when I get my lows which are rising, which is simply and effectively telling me that these are possible support zones. Price is forming support on it and it's going up. Subsequently, a change of trend is noticed once price breaks this particular trend line. It indicates a change of trend. The simplest and the most effective way of looking at a change of trend. Absolutely simple. We looked at the secondary trend. We had this absolute primary trend. Your secondary trend against the direction of the primary trend was over here. We plotted a trend line along the highs which were going lower. A break of this trend line gives you an indication that there has been a change of trend. Most effective and simplest way of looking at a trend. I have shaded this area over here as a sideways trend. This is a horizontal trend where neither is it a very clear uptrend, neither is it a very clear downtrend, but it's a sideways trend. Now again, time frame is very important. You're looking at a weekly time frame where price is in a range. If you go down to the 1 hour, you would probably look at this as an uptrend on the 1 hour. You could have looked at this move as a downtrend on the 1 hour. Your trends are also defined by the time frame you're looking at it. It's very important to align your time frames, to look at higher time frames, in effect to look at the larger picture. Right? So we had a look at what a trend is. Now, second important point, basics of technical analysis. I'm just trying to go over. These are the foundations. This is something one must understand, one must learn. Because this, if you do understand, it makes chart reading much more easier. Support and resistance. These are levels, very, very important levels in terms of market psychology and supply and demand. Finally, as I said earlier, price action is nothing but a result of supply and demand. Right? So in case of a support zone, you could interpret it that there are a lot of traders willing to buy the currency because hence it creates a support, and a resistance zone, there are a lot of traders willing to sell it at that point. So when these levels are broken, the supply and demand and the psychology behind the price movement shifts, in which case new levels of support and resistance are established. Now, one very important factor is a psychology of chart movement, or in my language, I call it the law of the charts. Once a resistance or a support level is broken, its role is reversed. If price falls beneath a support, that level often becomes a resistance. Right? And for an actual reversal to occur, it is important that price makes a very strong move. Let's have a look at what I am trying to explain as levels of support and resistance. Now, if you look at this chart frame, and you could do this, take any chart, and if you could plot horizontal lines across certain points, levels where price has reversed from, wherever price has given you some moves, we call them as pivot points or fractal bars in terms of technical analysis, you will see that price respects previous levels of support and resistance. If I take this example, price has stopped over here, give me a resistance, broken it, come back to find support over here. As I said, if your level of resistance breaks, it most likely turns into a level of resistance. More important, if you look behind over here, this level has held price previously in the past also. So which again sort of proves the point that historical analysis or historical patterns tend to reoccur. It's like I look at it, when I jokingly call at it, price movement is like an elephant. It's got a very, very long memory, very long memory. You'll be surprised at the extent of past levels of support and resistance which come into play even today. And looking at this example, as I said, you will have the PDF. You can notice it that any kind of support and resistance really works very, very effectively. If I look at this, price has found resistance over here, come back, again found resistance, broken through, come back to find support. Now this gives you very strong indications at this particular point. If I'm a trader, it gives me a very strong confirmation that price has got a very high probability of moving up because a previous level of resistance has turned support. The psychology of the market, or the movements, price movement has changed. As a technical analyst, I will take advantage of this particular fact. Right? Absolute basic simple stuff. Right. Let's go to the next one. Indicators. Now let's come back to indicators. Now, indicators are primary tools. They are nothing else but calculations. All right, Milton. I'm sorry. Is there some problem with this? Well, actually, what happens, Milton, is sometimes when I'm using the annotation tool, it sort of clashes with the room over here, and it sort of slows things down. But I assume I'll try not to use it as much as possible.
Sunil, you can try, pardon me, on the right-hand side, next to where it says full screen, there's a little pointer. If you click on that, it will give you a green highlighted pointer so you can note to where you're going.
Yeah. I think that's fine, yeah. All right, I got it. Okay, I'll try to use that. Okay, thank you, Craig. All right, let's get down to indicators. Could you just give me one moment? I have a little bit of problem with my mic. Greg, can I just take a 1 minute break? If you could take over, be back.
Absolutely, no problem at all. I'll give everybody an update as to where we're standing on our trades right now. Yeah. We are working.
Thank you.
I've given you the indications across the bottom. Currently working 4 trades. Let me go live. I'll flip over to our Thinkorswim screen, and you can take a look and see what we're working here. Hang on 1 second. Let me put this out to full screen and switch over to my computer screen. Second monitor, Big Piney Guinness. There we are. So we're currently working FX. Here we go. This is down here. We've got the 4 orders that we're working. We're offering 100,000 of the Australian dollar, bidding for 50,000 of the British pound. This is the bottom of the screen on the left-hand side. We are offering 100,000 of the dollar Canadian. We're offering 100,000 of the dollar yen. There are our prices, and I can't seem to be able to trying to get both on the same screen, and it won't work. For example, we're offering the dollar yen at 109.77. It's currently trading at 109.35, so we're about 40 cents away on our offer. The U.S. dollar versus the Canadian, we're offering at 104.88. The Canadian U.S. is now trading at 104.59, so we're about 30 cents away on the offer. On the buy side for our British pound, we are 1.8403 bid for 50,000. Pound is 1.833, so again, about 30 cents away. And finally, our Australian dollar, we've offered 100,000 out at 0.8592. Our friends in Australia are at, it's currently offered at 0.8577, so we're about 15 to 20 cents away from a fill on the sell side of our Aussie US. That leans into the long position that we had established earlier that I told you I was leaning into that position. And if also we may have gotten a fill. Let me see if I can show it to you here. I'm working on the right-hand side where it says messages. I'm trying to see if we got an additional fill. 5 active positions. For those of you who What I'm probably going to do is I've got these out now because I'm watching the market. What I will probably do when I finish up sometime late tonight is I will probably put out orders on both sides of the market, 1,000 deltas away, probably I'd be selling 10 mini lots on each of the upsides or buying 10 mini lots on the downside so that while I'm asleep, if anything would happen, I would at least get one trade off. I may even double them up and try putting out, let me show you how you would do it. I wanted to put out an order that was first triggers all order. The parent order could be a limit on the buy side, and then we can actually put out two trades beyond that. So I may, just to play with this function, put out a few trades that are contingent of first triggering the rest, and see how that plays out. So we've got some trades working. Again, the whole concept of this trading the spot against you when it goes up are making you long, allowing you to sell. The options position is because of its delta, making you short on the downside, allowing you to buy. So you're trying to trade effectively around your straddle back and forth with your options trades. Let me see if I can switch that quote board just to give us an idea of where we are on the day. This is just a different look at that Thinkorswim quote board. So I'm going to leave this up. Sunil is back and ready to go. Thank you for this commercial interruption. Sunil, I'm going to switch this screen back to our documents that you're working with. Everybody is ready to go. Thank you.
All right, back again, folks. Sorry for the break. Thank you, Greg. Let's get down to where we were looking at the trends. Indicators, sorry, we finished with the trend and we were looking at indicators. All right, now indicators are calculations based on the price of the currency. Calculations measures things like trends, volatility, momentum. Indicators are used as a secondary measure to the actual price movements, and they give you additional information. Now again, one more point if I want to make over here. There's a unfortunate misconception about indicators. Most of the traders, when they get in, they look at indicators as a leading factor. Now logically, as this one says, as we can see over here, indicators are calculations based on the price of the currency. So obviously it is your price which moves first, which subsequently affects the indicator. So your indicator is always lagging. It is never a leading indicator. Price is your ultimate leading indicator. This is one misconception which I try to put across to as many traders as possible, because unfortunately I have seen, as I mentioned before, a lot of traders come into the market, look at technical analysis, say, okay, now I know what the MACD is about, I know what a moving average is, and if this happens, I'm going to take the trade. Indicators should be used as the name suggests, indicators, not as a confirmation factor. Just keep this in mind whenever you're using with indicators, using any kinds of indicators. Now again, it does not undermine the effectiveness. They are effective, but again, I try to use an analogy over here. It's like a carpenter's toolbox. You must know in what situation which indicator has to be used. Would a carpenter use a screwdriver for a job which requires a hammer? He would not. Similarly, every indicator's got a separate characteristic to it. Every indicator has got its own advantages. It's got its own drawbacks. You must understand the indicators and use it to your best effect. Finally, they are lagging. They are never leading. Point number one. Point number two, you must use it to the effect to give you an edge in the market, because that is what you're looking for, right? You can use indicators in two ways: to confirm price movements and chart patterns, and to form buy and sell signals, in both ways. let's have a look at briefly at some of the basic indicators which one really uses, or a lot of traders use this, because these are the indicators which are available frankly on all the charting software. They are the basic building blocks, I would say, and they are effective in their own way. The first and foremost is your moving average. Depending on your point of view how to use it, it is one of the most effective indicators. At the same time, it is also one of the most lagging indicators. So you must know how to use it in what situation. Why does one use any indicator for that matter? So a moving average. Now, most chart patterns, as we have seen in the slides before us, they give you a lot of variation in price movement. You will have price waves going up, you will have price waves going down. Price never moves in a straight line. And it does sometimes become difficult to get an idea of the currency's overall trend. When price market is into an intermediate trend or a minor trend, it will become difficult for you to determine the trend at that particular time frame now, in this particular movement. A simple method is to use moving averages. Now, a moving average is the average price of the currency over a set period of time. Now, by plotting this average price, the price movement is smoothed out. That is the main point about a moving average. You smooth out the price movement. And once your day-to-day fluctuations or your intraday fluctuations, depending on what time frame you are in, once they are removed, you are able to identify the true trend, and of course increase the probability that it will work in your favor. Finally, you are planning to remain in the direction of the major trend, which gives you better probabilities of price movement. Now, since moving average rely on the historical data, they have a lagging effect. Now, the main drawback of the moving average is that this lag can delay your buying and selling decisions. So you have to keep that into mind. So using a moving average is a typical choice depending on what kind of a smoothing you want and the percentage of lag that you are ready to tolerate. So it becomes a correct mix of it. Again, I try to keep the fundamentals very clear. It is my duty to inform you about the advantages and the drawbacks of an indicator. Finally, the choice is entirely yours, but whenever you are using any tool, whether it's technical analysis on the whole, whether it's one particular indicator, whether it's a trend line or anything for that matter, one must really understand why you must use it, why you have to use it, and what are the drawbacks. And if there is a drawback, do you have any way to get over it? If not, then you do not use it in that particular situation. Right? So let's get ahead with moving averages. Now, basic stuff, there are three types of moving averages: a simple moving average, a weighted moving average, and an exponential moving average. Now, each of these have their own merits and drawbacks. Also, there are specific time periods where some of them are appropriate choices and you could use this. Now, I won't go into too much details because very frankly, if you do a Google search on a simple moving average, you would come across maybe 1 million sites on it. You really need not know the calculation behind it. The charting softwares today, all charting softwares have got moving averages. So let's not get into details which are really not required. You must understand why it works and where it works. That's more important. And which one to be used. Very frankly, I would prefer the simple moving average. It is one of the most simplest to use without complicating things too much. But there are situations where an exponential moving average works better. This comes subsequently when you go deeper into technical analysis, when to use which indicator in what situation and how, for that matter. Right? And main uses of the moving averages. Now you can identify first and foremost whether a currency is in an uptrend or a downtrend depending on the movement, on the direction of the moving average. It's rather simple that if your moving average is up and prices are above it, the currency is in an uptrend, and If it is a down sloping and price is below that, so it's in a downtrend. The currency is in a downtrend. Looking at the same chart example, if you look at this one, right? At this particular situation over here, you have your moving average. The moving average is sloping upwards. Prices above that. The slope of your moving average also determines the extent of the momentum. If price momentum is pretty strong, it's a strong trend, the moving average has got a sharper slope to it. And in this kind of a situation over here, price is below the moving average. When we looked at the secondary trend, looking at this, I would say my secondary trend, down move of a secondary trend, actually if you look at this, has started from this particular situation, right? I would have taken the down move from here when price crossed the moving average towards example of your lagging effect. The previous part of the move, let me get into this just one. I missed out this much part of the move due to the lagging effect, because once by trend lines, if I can determine this is a downtrend, then I have missed out a certain part of the move. This is what I mean when I say it's got a lagging effect to it, right? So simple concepts. Moving average, if you plot it, prices above that and your moving average is upsloping, prices in an uptrend, vice versa for a downtrend. Another way of determining momentum is to use a pair of moving averages. This is a very simple and a very common kind of a technical system where you use a combination of two moving averages. If a shorter term moving average is above a longer term moving average, the trend is up. On the other hand, if your longer term, or let's put it this way, a shorter term is below the longer term, the price trend is towards the downside, right? Looking at this example over here, excuse me for a moment, too much noise over here. I have plotted two moving averages on this one. One is a simple moving average of 100, which is the blue one. The other is, the green, the blue one. And you have the simple moving average, my mistake. Excuse me, please. I have the simple moving average of 50, which is the blue one, and a simple moving average of 20, which is the green one. Range of trends also can be determined by the simple method. This method is used by a lot of people. Once your 20 moving average is above the 50 moving average, price is in an uptrend. Your 20 moving average is below the 50 moving average, price is in a downtrend. A change of trend is often determined by the crossovers. Minute your 20 moving average crosses beneath your 50 moving average, price is said to have gone into a downtrend. If it crosses towards the upside, price is said to have gone into an uptrend. Now again, you will see the extent of the lag. Again, you're looking at a crossover over here. That means if price was in a downtrend from this point, I may have missed out on this much part of the move. That is the lag. So it's up to you to decide what kind of lag will you accept to give you a confirmation. Does not undermine the effectiveness, as I always say it. It's a correct mix. How would you want to use it to the best effect of where you are in? Right? Another way of using moving averages is to identify support and resistance levels. We had a look previously at horizontal levels of support and resistance. Moving averages do give effective levels of support and resistance. You will see that currency normally, if it is in a move, if it stops somewhere, more likely than not, it stops at a major moving average. And of course, a move through it determines that your trend has changed, right? Now again, this becomes very subjective, because what is a major moving average? Everybody uses a different concept. I could use a 20 moving average, a 50, 100 or 200. Some people use a lot of Fibonacci numbers. I know people who use only traders who use only Fibonacci numbers. They will plot a moving average of 13, of 55, of 89. So it becomes very subjective. So of course, price action always is your best. So I would prefer price action, but this is just something which everyone must be aware of. Now I have plotted a simple 100 moving average over here, and you can effectively see the circle parts where price has found support and resistance precisely at the particular moving average, at the moving average. So it is quite effective to keep it as a possible level of support and resistance, another use for it. Right, let's go to another commonly used indicator, which is the stochastic. Now this stochastic is an oscillator. There are different kinds of indicators. Oscillators are one class of indicators. Within your oscillators come your stochastics, the RSI, the MACD, the momentum indicator. They are all stochastics because they oscillate between a value of 0 to 100. That's why they are known as oscillators. Right? Now a stochastic was developed by George Lane, and it is a momentum indicator which measures the price of a currency relative to the high or low range over a period of time. Now again, I don't want you to get too much into complications into the actual calculations of it, but you must understand some basic concepts, because as I always say, if you are using an indicator, you must at least be aware of the background about why it is working. You must know the move behind it, the basic concept behind it. The stochastic relies on the principle prices tend to close near the upper part of trading range during an uptrend. Let's just take one point. Isn't it very logical when price is in an uptrend? Obviously, we are looking at a candlestick bar. If price is in an uptrend, you will have price closing higher. So price tend to close in the upper part of the trading range during an uptrend, vice versa for a downtrend. Now, when a trend approaches a turning point, the price closes further away from the extremes. So obviously, when you're reaching a turning point or when you're losing momentum in an uptrend, prices will tend to close lower in the range. Now the object of the slow stochastic, or the calculation of the slow stochastic, is it identifies these points in the trend and it gives you an indication that a reversal may be at hand. You see, why are you using a stochastic? What is the concept? Why does it work? Once you understand the basics behind it, that this is where it works, you automatically understand the situations in which you would use it more effectively. So this is the logic behind the calculations of the stochastic. Now interpretation, basic interpretation is a stochastic value above 80 indicates an overbought zone, which sort of tells you that the market is ready for a reversal. So if your stochastic is above 80, it means that prices are closing towards the upper end of the range, but there could be a loss of momentum and you could be looking at a reversal. A stochastic consists of two lines. They are called the percentage K and the percentage D lines. Now these generate buy and sell signals. Again, should not be effectively taken as written in stone. Right? Folks, just give me one moment. One moment. I'm right over here.
Good news, I'm still here, everybody. You haven't gotten rid of me that easily. It doesn't look like anything of any of our trades have gone off. Probably closest to maybe, take a look, selling a few. Again, we will pick this up at the end. Sunil, go ahead. I was just boring them.
Yeah, no, thank you, Greg. I was just trying to cut off the noise over here, a lot of background noise. Right now, I am talking about stochastics. Could I, Greg, could I refresh the screen?
I'm looking at the screen that says the interpretation of slow stochastic.
That's right. That is the slide
okay,
we
great.
are on, and I am
fantastic.
I am talking about. Okay, thanks. So we were talking about the stochastics now. The stochastic consists of two lines. They are known as the percentage K and the percentage D lines, which again I will not go into the detail of it, but they generate buy and sell signals. As I was saying, should not be taken as written in stone. Unfortunately, a lot of traders do exactly the same thing. If your lines cross much like the moving averages that we were looking at, then I would go long, and if it crossed towards the downside, I would go short. No, that's not the way to use it. The crossover is most effective when the stochastics are in your overbought or oversold zone and they have moved out of your zone. Remember, they have moved out of your zone. This is very important because in a strong trend, your stochastics will remain in the overbought or the oversold zone as the case may be and give you false crossovers. Another characteristic of the stochastic is that it can show divergence. When your stochastics or indicator is moving in one direction and the price is moving in the opposite direction. Now divergence is one factor or one point of the indicators which I always consider as leading because it gives you an early indication of a change of trend. Now this is a specific topic by itself. We will be having specific courses, and divergence is one of the most effective chart patterns that you can come across. You can anticipate price action. Finally, going on another point over here, a change of trend is obviously preceded by a change of the underlying momentum in price. And if you have a way to determine when your momentum is about to change, you are ahead of the pack, as they say, ahead of everybody else. Divergence is one such thing. Right? Going over back again, now the drawbacks. Again, you must know the advantages and the disadvantages. The basic drawback of this stochastic is it loses its effectiveness in trending markets. Now this may seem like a very contradictory statement because you are finally using an indicator when a market is trending. So if it is not going to work in a trending market, then why are you using it? But basically this is how it has been built. It is a very, very effective indicator for ranging markets, should not be relied upon when the market is in a trend. Because as I mentioned, your stochastics tend to remain in the extreme zones during a trend. Whereas in a range, if you're trying to capture some part of the range going up and down, bouncing the prices between levels of support and resistance, your stochastics would give you excellent levels of oversold and overbought. Now, to overcome this drawback during the trends, you should take signals or trading decisions in the direction of your main trend, your higher trend, and do not go long when your stochastic is overbought. Let's just take absolutely, Bruce, that is the best way to look at it. Say you're in an uptrend on my primary trend, right? Let me just show you what we are looking at. Now, if we are looking at this particular chart, again, we have plotted the stochastics over here. Let's go over different concepts. What I was looking at, one is my oversold situation. Stochastics is below your 20 line, which indicates that price is oversold and it should rally. Well, in this case, it does rally. Then I'm looking at a divergence. Now I've plotted two examples of divergences where price moves in one direction, your stochastics do not conform. This is called a bearish divergence, where you would expect a move towards the downside. Similarly, this is a bullish divergence where price makes a fresh low, but your stochastics give you a higher low. Bullish divergence. This is one of the most effective ways of using the stochastics. Now the disadvantage is when price is in a constant trend, your stochastics will remain in the overbought zone. They will give you false crossovers. Price will always snap back over there. Now how does one really overcome this? You must wait, first of all, looking at the longer trend. No, thank you. Great, thanks. Looking at a longer trend first, you must keep your longer trend is an uptrend, obviously. So you must try and only take longs when your stochastic is giving you a signal of a short. Try not to take shorts because eventually price is going to turn back in the direction of the main trend. and you would be better off trading in the direction of the main trend if you do happen to pick up the momentum in the direction. It's what I always say, it's like having this wind in your sails. You are also carried forward by the momentum. So you have to look at a lot of factors trying to determine a trade. Indicators become just that, an indicator, nothing else. Right, let's have a look at another oscillator which is very commonly used, which is the relative strength index, the RSI. Now this is a very widely used technical indicator. One of the reasons why I introduced this along with the stochastic, though both of them are oscillators, is the RSI has got certain advantages over the stochastic in some ways. Again, it is used to primarily identify overbought and oversold situations. It fluctuates between 0 and 100 values, giving you fixed overbought oversold levels. And it does this by confirming changes in momentum. Now the advantage of the RSI over the other oscillators is that it is smoother and it is not susceptible to distortion from unusually high or low prices. This gives it a sort of an advantage. It's like the moving average smooths price. Your RSI tends to smooth the price spikes out. Now if used properly, it is a very valuable tool. Of course, the basic functions is you're looking at the overbought and oversold and divergence, which we classified. Now more important, it can also identify price movement by forming patterns. Your RSI by itself could form a double top, a head and shoulders or chart patterns which are not clearly visible in the price movement. So it gives you a kind of a early indication. Similarly, areas of support and resistance show up on the RSI earlier than what prices. Again, similar to your stochastic, it will generate precise signals when the market is range bound. And your overbought, oversold and divergences show up much more accurately. Price when it is trending, similarly, it gives false signals because it tends to remain in your overbought, oversold zones most of the time. Giving an example over here, more important than which I have not plotted on the chart over here, but if you can have a look at it, just let me show you something. Of course, first and foremost is your divergence, which we observed on your stochastic, which you can observe over here also. Then you have an oversold situation where price rises up, very similar to your stochastic. In a strong zone, your RSI will tend to remain overbought. But more important, if you can have a look at it, which we will be going over subsequently in the technical sessions that we will be conducting, is it forms effective levels of support and resistance earlier than price, right? If I have a look at the rising highs, now if I am looking at a rise, if I look at this particular peak of the stochastic and I look at this peak, I look at this peak, I have three peaks in succession which have been going down. A break of one peak will give me an expected price movement before price. So I'm talking about this break. When RSI breaks its own trend line or its own horizontal levels of support and resistance, it gives you an earlier indication. So again, coming down to my base point, one must know in what situation which indicator works well. Surprisingly, I have seen traders that they try to complicate their charts so much. You will have a MACD plotted, you will have an RSI plotted, you will have Bollinger Bands and you will have moving averages, so much so that you cannot just see your price action. No, price is your first indicator. Your other indicators are only secondary. If you try and keep your charts as simple and uncomplicated, believe me, it makes it easier for interpretation. Right, let's go over another indicator. This is one thing which we should look at. Bollinger Bands is one of the leading indicators. Among all the indicators, I would say Bollinger Bands is comparatively more leading than the others. It's developed by John Bollinger. Now, it's an indicator that allows the trader to compare volatility and price levels over a period of time. So they provide a relative definition of the high and low, again overbought, oversold. Now this consists of 3 bands, which usually encompasses the majority of price action. It has a simple moving average in the center, in the middle. It has an upper band, which is your simple moving average, plus a standard deviation. Standard setting is 2, and a lower band is the simple moving average minus the standard deviation. Again, there's no need to go into the calculation since all the charting softwares really have that. Interpretation is more important. The basic interpretation is that prices tend to stay within the upper and lower bands. Now, because the most important fact why it works is if they work because standard deviation is a measure of volatility and the bands adjust themselves to the price condition, they will move along with the price. So they become a leading factor. They do not become a lagging factor. When the market is more volatile, the bands widen or move away from the average, coming back to the point which I had mentioned, and during less volatile periods, the bands contract. Now, this is a very effective way, specifically for options, is that the tightening of the bands is used by technical traders as an early indication that the volatility is about to increase sharply. This is a very important factor. All right, I think I had a raised hand somewhere, but if it could wait, we would be just finishing this, and I'll take some questions after that. Right, let's get over this. Right. So we were looking at the tightening of the bands. This becomes a very, very important factor for your Bollinger Bands. Now the characteristics, advantages and disadvantages. One is 85% of the price action is contained within the bands. That is the first and foremost. Very important factor. And sharp price changes tend to occur after the bands tighten. This again is a very, very important factor. Now, when price moves outside the band, a continuation of the trend is implied. That means price could continue with the trend. It does not necessarily mean an oversold or overbought situation. Right? There is another factor using reversal, which we would go over subsequently, is bottoms and tops made outside the bands. Now, if you have in an uptrend, you have a top made outside the band and your subsequent bar gives you a close inside the band, it is an indication for a reversal. And another point, or which is again used a lot by option traders mainly, a move that originates at one band tends to go all the way to the other band. So this becomes very useful for projecting price targets. If you have a move which originates from your lower band, it would tend to go all the way up to the higher band. This becomes very, very important. The chart example, let me show you a couple of examples where the advantages or disadvantages. Now, the first and foremost fact about the Bollinger Bands, which one must really keep in mind, is the squeeze of the Bollinger Bands. I have a question by Rob. You have a question, or is there? Greg, everything is fine? So far, things okay?
Yeah, everything is fine, Sunil. It looks like somebody tried to get their hand up. What we'll do is we'll just have everybody wait till after you get done this section, and maybe we can answer a couple of questions for them.
Oh, all right, fine. Okay.
I've got it fixed now for you.
Go ahead with this. Oh, thanks. Okay, first and foremost, looking at a situation on the squeeze of bands, you can see this situation where I have encircled this. Your bands are at the narrowest at this particular position over here. Now this indicates whenever your bands tend to narrow together on this situation as well as this particular situation over here, when your bands tend to narrow, it implies that there is going to be a volatile move. Now, of course, the direction is to be determined by something else, but the fact, like I said, for option traders, the very fact that you can determine a time when a price movement is about to take place gives you a certain edge, which your Bollinger Bands are usually very, very effective. This is the most important point. Similarly, or conversely, on the other hand, if your Bollinger Bands, as the situation is over here, are wide apart, that means your volatility would tend to reduce. Again, based on the simple concept that price tends to come back to its means. When it stretches beyond the means, it would pull back. So you would be looking at some period of consolidation, which again for option traders becomes the time factor. Very, very important point, which all of you all are looking at over here. So this is one technical tool which could be used as a secondary confirmation. Right? And looking at the characteristics, prices which start at one end of the band tend to continue to the upper end of the band. This is one more point. Right? Okay, let's go over. This is what the Bollinger Bands were very briefly. Now Fibonacci's. This is something of, I call it an advanced trading method, but something which a trader must be aware of for the simple reason that they work. Now, what are Fibonacci ratios? They are a very popular tool. They are based on a particular mathematical series discovered by a mathematician, Leonardo Fibonacci. The series is each number in the sequence is simply the sum of two preceding numbers. So you would have the series which is mentioned over here. Let me just show you the pointer. This is the series which is mentioned over here. You have 0 plus 1 is equal to 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. This is how the series goes right up to infinity. But it is not particularly the sequence which is important. It is the ratio or the relation between these numbers which somehow has got a lot of affinity, or I would say a lot of influence on the financial markets. One characteristic of this sequence is that each number is approximately 1.618 times greater than the preceding number. Right? So if you look at the series, you also have the Fibonacci ratio of 61.8, which is a golden ratio, which is simply dividing one number in the series by another one. So if you look at this, if you divide 8 by 13, it gives you 0.615, 55 by 18, and it gives you that. And if you do it the other way around, if you divide 89 by 55, it is going to give you 1.618. If you divide 144 by 89, it is going to give you 1.618. Now this ratio has got a lot of meaning. Again, don't get into too much complication about the whys, but just remember that this really works. Now, for some reason, these ratios play a very, very important role in the financial market, just as they do in nature. If I have time, I could show you a lot of things where the Fibonacci series particularly is part of nature. As a human body, just on a very light note, if I may just go over some things. You see, the human being's navel, the belly button as it's called, if you take the ratio of from head to navel to your entire height, it will come to 0.618. If you take the ratio of your entire arm, shoulder to elbow length, shoulder to entire arm length, it will be 1.618. If you take your fingers, they will also have a relation of 1.618. So it works in nature. There are a lot of things where Fibonacci ratios work. So obviously, I would look at it that since your price movement is based on human nature, so obviously this series would also probably have some effect somewhere. Right? We will not go into the whys. We will go into the where and whens. Excuse me. If they work, let's try and take advantage of it. Let's not try and go into why it's working. Now, price has a very uncanny way of respecting Fibonacci ratios, and very precisely. So you can take advantage, you can use these ratios to ascertain correct technical levels. The Fibonacci retracement is one of the most commonly used Fib method. in real time in my series or in my technical analysis, I also use the Fibonacci projections, the Fibonacci expansions, the Fibonacci fans. All of them are very effective, but again, you should know which situation it has to be used to. Let's just have a look briefly at retracements. What exactly is retracements? What you do is you take two extreme points of a price wave, a swing high and a swing low, and divide the entire vertical distance by the key Fibonacci ratios, which is derived by those numbers which we just saw. 38, 50, 61.8, these are the important ratios. Horizontal lines on the denote possible levels of support or resistance, and is likely to continue once price has retraced to these ratios. Now what I mean by this is, what we did over here is we are looking at this secondary wave. This moved down. So what we did was we took this swing high to swing low, vertical distance, and plotted the 38.2, 50, 61.8 ratios over here. And you can see when you will have a look at the charts, price stopped for some time or the other precisely at these ratios. And it gives you possible levels of support. Now this last reaction of price stopped precisely at 1 fib ratio, started rallying up from here, which gives you that this was a very effective level of support. Of course, again, as I said, nothing should be used in isolation. You have to use some other confirmation factors to get into a trade, but these are tools which give you an early indication. Finally, what you want is an early indication. You want to try and get ahead of the pack, try and get an advantage over the other traders. That is what trading is all about, right? So these were the Fibonacci ratios. Let's have a look at one more system, which is called the pivot points. Now this again is a very, very commonly used technique. Now this is a technique which was developed by flow traders to ascertain where the price is relative to a previous market action. A pivot point in basic sense can be defined as a turning point. Now more important, it is a technical indicator which is derived by calculating the numerical values. So it is a level at which the sentiment of the market changes. As a thumb rule, it can tell you the sentiment of the traders or the investors from a bull market to a bear market. In a very basic way, that is what it is. Now these work well on very liquid markets like the spot currencies, but they can be used on other markets also. The main advantage, the reason why we are going over this, that it is price based. I would definitely prefer any system which is more price based than indicator based. By the time most indicators generate a signal, the move is well underway. But with the pivot systems, one can possibly get into a trade before the indicator following traders. Let me put it this way, right? What we are trying to do over here is, if you are studying technical analysis, you want an advantage over the other traders. Education is very, very important. The statistics, on a very brief note, if I may say, that 85% of the traders lose money in Forex. Now there has to be a reason. Or to put it the other way around, if the 15% is making money, do they have something called the Holy Grail? Well, obviously not. They have a method. There is a reason. What I believe is, trading is like any other business. You have to educate yourself properly before you jump into these shark-infested waters, or you will get eaten up, period. So you do not want to end up as another statistic. That is the reason why you are studying courses. You are looking at options. You have Greg drilling things into you every day. You have technical analysis. Obviously, you want to educate yourself so you become a better trader. You want an edge in the market. So these systems which we are trying to show you is something which will give you an edge. The pivot point by itself gets you into a trade before the indicator following traders. This was the baseline what I wanted to make. You do not become an indicator following trader. you become an educated trader by studying all these things, right? Okay. Now, interpretation in a basic sense, of course, we will be having specific courses subsequently on pivots, on specific strategies where you can take advantage of the technicals that you are studying today, that you are looking at today. These are just a background to build up a foundation. In its basic interpretation, you can say that the market, if the market breaks the pivot level towards the upside, it's a bull market. If it breaks your major pivot level towards the lower side, it's a bear market. So it can be used as a predictive indicator, right? If your following day's market falls below the pivot level, it may be used as a new resistance level, very much like the levels of support and resistance. Obviously, if it raises above, if it rises above, rallies above, it may be this pivot level may act as a new support level. Now, what exactly are the pivot levels? I have just given the calculation over here. The central pivot level is the most important. This is your first calculation. It's taking the previous day's high-low close. You put into this, add up the high-low close divided by 3, it gives you your pivot. Your first resistance level is your pivot value into 2 minus the low of the previous day. So you see, you are using the previous day's price action. Your indicators do not come into the picture in any way. And a pivot, if you calculate these levels on the chart, they sort of give you a map for the day as to where price is headed, where are the possible level and resistance zones for the current trading session, which is very, very important. Right now, briefly, let's have a look. I'm just giving you what are chart patterns, because this is what we will be conducting courses on, these things which work. So it's important that you get a foundation of this. Now, a chart pattern is a distinct formation on the chart which creates a trading signal or a sign of future price action. Chartists such as myself, right, use these patterns to identify the current trends and trend reversals. There are two types of patterns, chart patterns, which are reversal or continuation. A reversal pattern indicates that a prior trend will reverse on completion. You remember the divergence we were talking about on the slide, which is indicated on the slide previously? A divergence is a reversal pattern, a very effective reversal pattern where you would expect price to change. So it is a chart pattern. A continuation pattern, on the other hand, signals that a trend will continue once the pattern is complete. The most commonly used, of course, you've heard of all these: the head and shoulders, a double top, a flag formation, triangles, 1, 2, 3s. Believe me, studying these will give you a much better edge on the market if you are a serious technical analyst, for that matter. Of course, if you are interested in this, if you want to go ahead with technical analysis. The bottom line, or the last part I want to go over, is using multiple technical indicators. You have to, as I said, use the different advantages and drawbacks of the indicators to give yourself an edge. Now, technical analysis is used for predicting price action. It's another factor to put the odds in favor. Now, since Forex is a very liquid market, currencies tend to trend well, you should try and ascertain a trend at its earliest stages. So obviously, a second confirmation or confirmation from 2-3 different factors will give you an edge. Relying on a single indicator to provide signals for the trade is not advisable, because finally your indicators are lagging. But if you have another factor confirming the same signal, the probability of your trade increases. So multiple sources of confirmation excuse me please, they help to avoid potential false signals. Reservations provide you with the most favorable risk to reward ratios. Finally, you are looking at something which will give you a high probability. Now, a confirmation factor can be another indicator, but ideally it should be a price action. So a price pattern, a chart pattern. So a combination of an indicator with a chart pattern can give better results, but that becomes a little complicated. Let's have a look at a situation where we have used two indicators. What I have done is to try and show you how does one take advantage of the characteristics of the indicators. First and foremost, your indicators should be non-correlated. Now, most indicators tend to give similar inferences. Obviously, your oscillator class, if you are going to use your RSI and your MACD and your stochastic on the same chart, all three of them are giving you the same conclusion. So why would you want to complicate things further and try and look for some clues which are not being given? You must try and take indicators which are not related to each other. So for that, obviously, you need to understand the advantages and drawbacks. Now, we have used a moving average crossover, which we just went over. The reason why I've taken one particular example is because we went over the moving average crossover. I will combine it with the stochastic. Now, why am I doing that? See, in a trend, your trend is indicated by a moving average crossover, right? Your moving average crossover tells you prices in an uptrend or a downtrend, and a stochastic gives you an overbought or an oversold situation. So we are using the characteristics of both of them to get a better setup. Now, if you have a look at this, what I'm doing is in an uptrend, this is an uptrend, constant uptrend over here, where your slower moving average is above. In this case, your 20 moving average is above the 50 moving average. Obviously, you would tend to remain long. What is the best place to take a long? Your best place to take a long is when your stochastic is oversold. This particular situation. When my stochastic becomes oversold, I have a stronger confirmation that price will rally, and I already know the trend. I am aware that it's an uptrend, so I will take a long over here, which will carry my trade further. The momentum will automatically push up my trade, and it will give me a much better trade. You see, on this entire situation, I could identify only 3 trading signals, if you can please, on this entire thing. One is this sell situation. Now over here, my moving average shows me a downtrend. So I would look for my stochastic to remain overbought. In this situation, my stochastic pulls towards the upside, which tells me that it is overbought and price will remain down. It will go down in the direction of the trend. Similarly, in this particular situation, I had a crossover. My uptrend has just started and my stochastic went in the oversold area. Now this particular price movement would have been absolutely excellent. Right? So this is what I'm doing, is I'm taking advantage of the characteristics of the indicator. So this was just an example just to show you. Right, so that brings us to the end of the session. I hope everything you enjoyed this. More than anything else, I always try to look at trading as fun. As it is, you have got enough stress while trading. Try and make it a little more fun. Try and enjoy what you're doing, and you will definitely get better. All right, there time for some question answers. We have some time. I'm over here. I'll let Greg take over for some time, and I'm here. So if Greg
Thank you, Sunil. That was great. That was great. I'm going to let everyone take a moment to type in some questions for Sunil. We will then finish out the evening going back and taking a look at any of the positions that we may have on, if we've put anything on in our spot trading against our long straddle. So let's try to type the questions in. We will try to answer them one at a time while we have Sunil. There's a good one, Sunil. What indicators do you use normally on your charts?
Yeah. Okay, Dave, as far as possible, I just use the slow stochastic. That's it. I am more into Fibonacci's. I use a lot of Fibonacci's in my day-to-day analysis. Bollinger Bands, not really too much. I try to keep it as simple as possible. My primary tools are Fibonacci's, levels of support and resistance, and chart patterns. And if I use indicators at all, it is only the stochastic, for the simple reason that I use the stochastic to determine divergences. I have found the stochastics to be the most effective. There are different kinds of divergences. There is a regular divergence, there is a hidden divergence, and this is what I use. Yes, Bruce, I try to use 5-5, 9-5-5 preferably, but very frankly, if you use 14-3-3 and if you use 14-5-5, preferably try and use the 5-5. Your two settings of your percentage K and D lines should be 5. 3 becomes a little too volatile, right? All right, George, difference between technical analysis for FX and stocks? Nothing, George. For me, as the common saying goes, a chart is a chart is a chart. If a charting system, now the beauty of financial instruments is what works on one time frame and on one particular financial instrument will definitely work on all time frames and all financial markets. The bottom line is your technical analysis works in a liquid market. Take any liquid market, whether it's your equity, your commodity, your futures, or your spot. It has to work. That was 955. Okay, Chuck, what time frame? It depends on what kind of a trader you are. I'm not an intraday trader. My primary reference time frame, if you would call it, is the 4 hour. I try to take my trends on the 4 hour and I trade on the 1 hour. I keep my daily and weekly in perspective, but 4 hour becomes my reference thing. So I try to look for trades, entries on my 1 hour. This is what I do. Gabriel, discretionary approach. Well, Gabriel, that's a very interesting question. Let me get down to one point of it. It may be a little long, but very frankly, for trading, any kind of trading, whether you're trading options, futures, spots, your technical systems, what I believe in, is it forms only one part of your entire trading approach. For me, the concept of 3 M's is the most important concept, which I believe every trader should be aware of. Your 3 M's: money, mind, method, in that order, right? Your money comes first. Money management is your primary reference for a trading plan, the most important part. Second is your mind, your personal approach towards trading, your psychology. The third and the last one is your method, which is your technical analysis. Now, when you ask about mechanical systems, if you ask me to break down trading on a scale of 1:10, I would give 5 parts to money management. I would give 3 parts to the mind part of it, your personal psychology, and only 2 parts to a technical system. Bottom line is, if I give you the best technical system with a very high success ratio, if your money management is not correct, you will not make money, period. Hence, if you talk about mechanical systems, you might purchase the best systems. Finally, it is you who determines your success and your failure. If your trading plan is correct and if it is absolutely perfect, then even a simple moving average crossover will make you money. If it is not, even the best mechanical system with absolute strict rules for entry and exits will not make you money. Believe me on this, it's like been there, done that. I have traders coming, I do personal coaching. I am more into determining trading plans for individuals. Concentrate more on your money management, which I'm sure even Greg agrees with me. Trading is a system. Your trading technicals is your base for your technical analysis, but finally, bottom line is your money management. And when I'm talking about the mind, see, this is one thing which I would really like to touch upon. Your personal psychology. I always tell my traders the simple fact of a success and failure of a trader could be as simple thing as writing down a trading journal. If you do not have a trading plan, you will not succeed. Now, this may sound very crude, this may sound very discouraging, but the fact remains, it's human nature. Once you have something set down on paper in front of you, you would obviously at least try to follow it. If you do not have everything written down, you are entering the market based on some whims and fancies. You're just going because price is rallying up, oh, I'm entering into a trade. Try and put a trading plan. Put down a checklist. This is what it is. If this happens, I enter the trade. My checklist for my technical system consists of points 1, 2, 3. If they are satisfied, I enter the trade. If they are not satisfied, I do not take a trade. There may be 2 days, 3 days, 5 days where I will not get a trade. This is where your personal discretion comes in.
Sunil, I'd like to...
It's my saying. Yes, please go ahead.
Pardon me. I'd like to tell everyone that when you mentioned about the importance of money management, so the class knows Sunil has not listened to any of our classes. He has not seen any of our PowerPoints, and you may not be surprised to find out, Sunil, that I have been singing the exact same song that you just did, telling people about the importance of without money management, you really just don't have a chance to make money. So I wanted to tell everybody that was not a setup. I didn't ask Sunil to point that out. He's not been in any of our classes, and he hasn't seen my PowerPoints. So we have someone on the other side of the world, an expert in foreign currency, spot trading, and technical analysis who agrees with us. So it looks so convenient that I was afraid people were thinking, oh, Greg had Sunil say that so that it would reinforce his point, and it's completely the opposite. We have not spoken about that at all. We've spoken about this class and the topics on the PowerPoints, and that's been it. So I completely agree with you. Does anyone have any more questions for Sunil while we have him?
Which, Greg, very frankly, it's a very important part, but unfortunately, absolutely overlooked by most traders.
Well, I gave an example in a previous class that if even in the most basic money management system where you're prepared to lose, in a Forex example, you're prepared to lose 50 pips trying to make 100 pips, and just using a 2-to-1 ratio. When I showed them the math, it says that you only have to be right 1 out of 3 times to break even. And again, we're not in the mindset of breaking even, but you don't have to be right every single time if you manage the trades correctly. And the biggest thing I always talk to people about is that if you can lift your limits and allow your winners to run as long as you follow them up with stops. But the people and the hardest part, as you know, teaching traders, the hardest thing to get someone to do is to take a loss. It goes against everything that they just will not. And if you can get that discipline to just take your loss and reevaluate, step away from the trade and what do I do next? And I've been preaching that. I really believe it. I've known guys who were great options theorists. They could espouse option theory like no one else, and they could not get out of their own way trading because they just couldn't manage the trades, and that is the key. We have Renee with a hand up, and what I'm going to try to do...
Yeah.
I can't seem to get it. Renee, can you type in the question? Okay, here you go. Renee's got a question for you there, Sunil.
Yeah. Okay. Renee, I would come back to what Greg just said. How do you make a plan? Well, making a plan is also more of an art than a science, but it has to be a very ABC approach to it. You have to have a kind of a checklist. As I said, I concentrate more on individual traders designing plans. First and foremost is you have to determine your trading system. Now, your trading system is determined by your personal choices. What is the amount of capital you are going to put in? What is the time you can devote to the market? What kind of technical analysis you are comfortable with? Based on that, we design a trading system which suits you. Second part comes as to the money management. Now, this is a trading system. All right, now one part of your plan is done. You define a checklist for your trading system that if this happens, I enter a trade. If this does not happen, I do not take a trade. Now, if I may give you a saying, which I always put it, trading requires the patience of a saint and the discipline of a soldier, which is a fact. You have to have the discipline to wait for your setup. If there is no setup, you don't take a trade. You may sit for 12 hours in front of your computer, but if you don't have a setup, you don't take a trade, period. This is the first and foremost thing which a trader must understand. And what Greg said, you must learn to take a loss. Believe me, we talk about that if you have a win-loss ratio of 50%, out of every 10 trades, if you have 5 trades correct, you are considered to be a good trader. There is nothing wrong in it. And what Greg rightly says is most of the traders have got this ego problem, you would call it, that I want to get each and every trade correct. You cannot. Get over that. You cannot get each and every trade correct. Follow your money management correct, and if your 5 trades correct, will put you ahead of everybody else. So you are discussing your technical system is correct. Then comes your money management approach. Once your setup has been identified on your chart, then comes the discipline to follow that technical setup as per what you have written and no deviation from it. Oh, you have the discretion of changing some things based on the market conditions, but you follow it. Your technical analysis is followed up with your money management. You define your money management and you go in with a trade. You define your entry, stop, exit. Your third point is managing your trade. As again, Greg. Now, Greg and me are absolutely on the same plane, but as he rightly said, neither have we talked about any systems. Follow up your trade with trailing stops. Try to take out the maximum profit you can from the trade when that comes from managing your trade correct. It is never a fire and forget system that you take a trade and you forget about it. No, you have to manage it. That in a nutshell would be a plan. So I've given you how do you make a plan and how do you determine the criteria. All right. Interested in further reading? Kim, Carolyn, definitely. If you could give your emails, if you could send it across to Greg. I have got some ebooks on primary technical analysis, just basic technical analysis. I will forward it out to you. It's not an issue at all.
George,
yes,
I'm going to take...
George, we do.
Yeah. I'm sorry.
Go ahead, Greg.
George, I'm going to chime in here. I'm not sure how Sunil tracks his. I like technology as much as anyone, but when I put my trades in, I really like to just have a pad of paper and a pen. I know that sounds completely old-fashioned, and I'm showing how long I've been doing this, but to see it written down in front of you and to, mark off the ones that are filled and know just the idea of being able to hold it in your hands and see where you are, to me, that's how I do it. And I believe that that's a great way to track your trades. It's great to be able in Thinkorswim to go in and look at your positions, and it is very helpful to be able to analyze it, but particularly for something like when you're actively trading, trying to gamma trade the FX, I just really think the notebook, and I know people actually keep notebooks, like old school composition books, and keep notebooks of their trades. So, yeah, technology is great. The KISS principle applies over and over, George.
Absolutely, Greg. If I may say so, it is very simple, as I said. Well, sometimes, Bob, sometimes. The simple fact of writing down or keeping a trading journal is very, very important. I have my trading journals for the past 6 years, and believe me, I keep revisiting them, and I look at what I did about 6 years back, and I say, oh, how the hell could I have done this? Couldn't I see this? You look at your losses and wins behind, it makes you a better trader. So there is, as Greg rightly says, there is no particular method, log sheet. Even if you have a concept of writing down your trades every day and of course revisiting them, you can't just write it and forget about it, you will be a better trader, definitely. Dave, yes, I do. The ones which matter. Believe me, you would probably laugh at it, but I keep copies of the charts where I've had losing trades because it gives me a perspective that this is where I went wrong. This is what I did wrong when I should have done this. So anytime I want to kick myself, I go back to those charts and say, look, how could you have done this? I mean, couldn't you have seen this? So yes, I do keep copies of the charts.
We are going
Oh,
to
you're
make
welcome,
last
Vinay.
call for Sunil. And what we'll do is we will thank him, if no one else has any questions, thank him for his time. We will see him again or hear him again next Thursday night as he closes out our 9 nights of FX options trading with his best time to trade the market presentation. So we are going to thank him. Sunil, I appreciate it. I will catch up with you on Skype or via email either later this evening, or which is your morning, my going to late night, or I will catch up with you tomorrow, maybe when we're both awake. I appreciate it. I'd like to thank you very much. It was very informative for me. I'm hoping the students got as much out of it as I did, because I know I learned a lot. I enjoy looking and listening to other people's perspective on the market, particularly in a subject where I do not have the kind of expertise that you do or someone like Wayne or Ryan does. So thank you very much. It was a great one, and we are now going to move on to taking a look at our positions, guys.
Okay, I'll sign off over here, Greg. It was a pleasure being over here. I enjoyed it as much as everybody else, and I would really want to be back. Thank you, everybody. It was a very interactive discussion, and I enjoyed myself. I hope to see you folks again. Thank you very much.
Thank you, Sunil. Guys, I don't know if you've lost the chat window and the out of your screen, but and I don't know what's happening. Someone is we're either losing it from Adobe, or I'm not sure why we're losing it, but my chat window keeps going away. So what we're going to do is we're going to go through the trades that we've got out here right now. I'm gonna take a look. I'm gonna work off of the Thinkorswim, and I'm going to probably keep the spreadsheet on the other page. I need to have both open so that I can take a look at what we're doing. All we're going to do now, and again, if you're not interested in gamma trading, if it's not something that you want to do, no problem at all. If you want to cut off, it's been a long day for everybody, I'm sure, and we will be back at it again. Remember, it's not next Monday. Pardon me, it's tomorrow night. I apologize. I don't know what day it is. We'll be back tomorrow night at 9 p.m. Okay, well, knock it off, recorder. Now I know what it is, at least. We will be back again tomorrow night. But for right now, I just want to give everybody a glimpse. Everyone should have gotten a copy of that spreadsheet. We're just going to quickly go over the trades that I'm going to lay out for the overnight session while I'm not in front of the screen, and we are going to try to get those up now. So thanks, everybody. If you're going to jump off now, we will see you tomorrow night. If you're going to hang with us, I'm going to be you're going to find me literally talking to myself, and I'll apologize in advance for that. Just the way I do it when I'm trying to put trades in and do the math. I'll probably sound like the Rain Man speaking to myself. I'm not claiming his intelligence, just the quirkiness of sometimes speaking to myself. So you're prepared. Absolutely, Renee. It'll be part of the PowerPoints that we send out. His presentation will be part of it. So great question. Let's take a quick look. I'm going to put everybody onto my Thinkorswim platform, and then I'm going to bring up the spreadsheet on the second page. You're on the monitor, and I'm going to move this off so I can work with it over here. I'm going to update the quotes. This is just so you guys know what I'm doing. I'm on the other side. I'm updating the quotes. The Aussie 85.81, the pound 184, call it 40. The euro 146.98.97. The Canadian, I've got to convert because we've got the backwards forwards base currency difference. So the Canadian 1.04, call it 55. The inverse 95.64 for our spreadsheet. I realize I'm going fast, and I apologize. I'm just trying to let everybody see how I walk through deciding what I'm going to do and what trades we're going to put out. We've got to get the inverse of the yen. So we're looking at 109.25. Inverse is 91.53. And then the inverse of the Swiss, 1.09, call it 70. Inverse, 91.16. Okay, that leaves us with a long position. We're pretty flat everywhere. I'll bring the spreadsheet back over now. Let me just double check the deltas. They're the same. Go back to FX. Okay, so here's our spreadsheet. Let me put it out this way. So we are right now, the only position where we've really got anything out there working that's big is we're long the Aussie at this level. We are working an order out at 85.92 in the Aussie. If we take a look at where it's trading now, it's actually trading just below there. We could get a fill on this one while we're on the line here. Again, we're working a 10 lot, would take us to a flat delta position based on our projections and our gamma. So that's what we're working. The other ones we have out there right now is we've got a buyout in the pound below the market. We're working an order at 1.8403, which is below the market. We've got a couple of spot trades on the sell side. We have the Canadian out at I got to convert this back over. It's 0.9529 inverse. We're working an order at the Canadian at 1.0465. Is that correct? I'm sorry, that's incorrect. We're not. We're working on the sell side. We are Canadians out at 1.0488. We're on the sell side. So we're a little bit away in the Canadian, and we are in the yen also working 109.77 with the yen trading well below that 109.24. So we don't really have much going on. We just missed. Probably going to get a fill on our Aussie. I'm going to go through now. I'm not going to take everyone through every single little nuance here. In effect, what I'm going to do is I'll give you the spreadsheet. I'm going to walk through and get out. This projects where our upside, and what I'm talking about right here. These trades give us the levels that I would need to sell. Well, this is where I'm going to be long, and I'm going to need to sell deltas. We do know that to sell deltas in these last three, I actually have to buy the spot. And then I'm going to put out the same 1,000 deltas on the upside for all of these. So when we go out tonight, I'll probably have 6 trades out on the upside, 6 trades out on the downside, and I may even put a few trades in between to see, depending on where we've traded for the day today. So again, this is, since I'm not going to be watching it, you could, if you wanted to, and it all depends on personal style, you could put out orders that are 500 deltas each, and then let me show you what you could use here as an order. Move this off your screen. If you went to enter an order, a new order, and you put a first triggers all, you could put a euro limit order out, and this is your first order, and then you could follow it up by putting out buys or sells below or above that, depending on what you do. So you could put out an order that, let's just say, for example, you were able to, you put this out as a sell, and you sold it here at 98 or at par, and then the buy below, you could set that to be, say, 146.50, so that when you sold it at 98, you would have a buy order out that would buy back say the 5 lot that you sold, trying to flip 50 pips on a 5 lot with one order. Again, it wouldn't trigger until it hit your upside parent order, and then it would, after that, implement any other trades. And you could maybe put one below that where you said, okay, I also want to buy down at 46.01. So if you sold at 98, you then would follow up with 5 lots below that. So in contingent orders, again, I like using limits, particularly, obviously, if you're going to be putting them out and leaving them on the book. You want to make sure that you've got limit orders out there. We currently are working these 4. There are none there. I'm probably going to eliminate the pound buy side. Right now, the pound bid is 184.03 with the pound trading at 184.40. I may leave that order there, but I'm going to put out orders on both sides of the market and see if we can get some execution during the evening. So that's, again, we're using this spreadsheet, figuring out where would we sell, where we buy on the downside, where do we want to sell on the upside. And for those of you that wanted to know what this was, this just pulls the numbers from over here, our quotes, and then automatically gives you the inverse so that you can look at the quotes on a system like Thinkorswim, because they quote it. You're going to see a Canadian quote of 1.0456, not 95.64, which is the world currency option, or 109.25, or 1.0970 for the Swiss. So that's why that little converter's there. I hope everybody finds it useful. Again, it's just a tool. I'm going to try to work on it, see what I can do to make it a little bit better, more useful for all of us. And if I get any updates, I'll be happy to get them out to each of you. So see if I can get this to come back to my technical analysis. We are back. Okay. I want to thank everybody again for hanging in there. I will see everybody tomorrow night, 9 o'clock, when we will pick up with our discussion of gamma and the world currency options and spot options, and then we're going to begin talking about futures replacement, covered calls, and covered puts. So everybody have a great evening. Thanks a lot, and I will be here. I'll keep it on if anybody needs to ask a question. If not, feel free to enjoy your day, your evening, depending on where you are in the world. Thanks. Have a great night, everybody.